In this lecture we will present the advantages and limitations of each valuation method. Starting with the discounted cash flow method, also known as the DCF, we can say that it is the most precise method for estimating a company's intrinsic value, because it considers the specific financial and operating characteristics of the company. In addition, DCF method is not dependent on other similar companies, transactions or market conditions, contrary to the market valuation methods that will be presented later on. On the other hand, DCF method requires financial modeling, which is a complex process that may take a lot of time, relative to the other methods. Also, DCF method depends on multiple parameters and projections about companies' future performance, such as revenue and profitability growth, capital expenditures plan, and capital structure, among others. Keep in mind that the more the parameters in our model, the higher the probability for errors. Lastly, DCF is very sensitive to certain parameters, such as the weighted average cost of capital, the perpetuity growth or the exit multiple. Therefore, it is deemed imperative to run sensitivity tables that show how changes in these parameters affect our valuation results. Next, we have the dividend discount method, also known as the DDM, which is a quick and easy method relative to the DCF. DDM relies on estimating future dividends, which are relatively straightforward for dividend-paying companies, whereas DCF requires forecasting cash flows, considering terminal values, and determining appropriate discount rates, making it a more complex and time-consuming process. On the other hand, DDM is appropriate for companies that have a stable dividend history and their profitability is proportional to their dividends. In addition, you should note that DDM works from a minority shareholder perspective and not from a controlling shareholder perspective. Therefore, a control premium needs to be applied in order to estimate the total value of the company. We'll talk about control premiums in later modules. Now, for comparable trading multiples method, we can say that this is the most popular method, due to its simplicity and its easy availability of inputs. Also, comparable trading multiples method provides readily available pricing by the market itself, so it is deemed more appropriate for valuing listed companies with a similar level of marketability. On the other hand, comparable trading multiples method ignores the specific financial and operating characteristics of the company under valuation, and solely depends on the pricing of other companies, as well as market conditions. Lastly, precedent transaction multiples method has the benefit that it provides prices paid for real transactions, including acquisition premiums. Therefore, we don't need to take into account any control premiums. On the other hand, precedent transaction multiples method requires collecting less readily available information, such as deal sheets and financials from non-public companies. This kind of information is way more difficult to collect than data required for comparable trading multiples method. Also, precedent transaction multiples method ignores the specific financial and operating characteristics of the company under valuation and solely depends on other transactions, which might not be indicative to our case. In other words, each one of these transactions has happened with different rationale and perhaps under different economic conditions, so it might be irrelevant to compare them with our company. Thanks for watching.